Welcome to your presentation on hotel pricing. Before we start, let's make sure we all feel comfortable with some key hotel operating measures, as I'll be using them quite a bit throughout this presentation. So, ADR, average daily rate, is going to be our total rooms revenue divided by our number of rooms sold. Our occupancy percentage is our total rooms sold divided by total rooms available. And then our RevPAR is going to be our total rooms revenues divided by total available rooms for sale. Or in some cases, if you have your average daily rate and your occupancy percentage, you can multiply these two to discover your RevPAR. Okay? These are typically going to be measured by day, by week, by month, quarter, and by year. Okay? So let's just make sure that we all feel comfortable with these three metrics before we move forward. So, hotel pricing. Hotel pricing really follows the law of demand. It's a bit different than restaurants in that way, in that price is very much affected by demand. Demand being how many people are actually staying, how many people are reserving hotel rooms with your hotel. The more people, the more demand there is, the more hotel rooms are being reserved, the higher the price goes. The less demand is, the more demand goes down, the more likely prices will go down with them as well in order to try and attract some demand. Okay? So hotel pricing, people are able to actually do this quite a bit with hotels, and a lot of that is because it's perishable inventory. Rooms are perishable. What that means is after a night passes, you can't actually go back and reserve that and sell that room again. It's gone forever. Okay? So you have lost the opportunity to fill that room. There are some hotels that would rather just have anyone sitting in there, staying in their rooms for a much discounted price in order to just have that revenue come in. Okay? Now, hotels have to use something called revenue management in order to manage the price versus demand properly, so that you're not charging not enough, but you're also taking advantage of certain moments in time as well. So what is revenue management? Well, it's also referred to as yield management. And it's really a different amount of techniques and procedures that we actually use to be able to try and manipulate our occupancy percentage, our average daily rate, or both, to then make as much revenue, as much sales as we possibly can. Okay, so again, that's by day, by month, by quarter, by year. Okay, revenue management should be used during low and high demand times. It's not just for low times, it also should be for high demand times. So some basic approaches that are used with revenue management in hotels, okay, is what happens is you want to first forecast demand. Okay? When you can start to forecast demand through your historical information, that could be last week, last year, the same month, last month, you want to make sure that you're trying to compare like months, but you'll be able to forecast how many rooms, what you think your occupancy percentage will be. Now, once you discover your demand, you can start to eliminate discounts in high demand periods. So if you have a high amount of people coming in, you can start to charge closer to your rack rate because you have so many rooms being reserved. It's high demand. You can also do it to increase discounts during low demand periods. So when there's less rooms being reserved, if that's what you're forecasting, you could start to implement a bit of a price dip to make sure that you try and increase that demand and get rooms reserved. Okay? You can also look at implementing special event rates during periods of extremely heavy demand. You think back to Canada Day with 2017 for the 150th anniversary, and during that time, the rates that were being offered by hotels in the downtown area were astronomical. Okay? They were much bigger than you've ever seen. Again, that's because of extremely heavy demand. And you'll see different cities, different hotels do this depending on what type of event is going on at that moment in time, what the demand is like. Okay? Now, before we get to how we can start to evaluate, how can we start to price out our rooms, we need to make sure that we don't forget about something else that comes with hotels. And that's something that we call non-room revenue. Now, what do we call these revenues really in our industry, in the hotel industry? You won't hear it referred to as much as your non-room revenue. What you will hear it referred to is as ancillary revenue. ANCILLARY, ancillary revenues. Okay, that's just another way of saying non-room revenue, but that is the way that they're referred to in the hotel industry. So some example of non-room revenue, of ancillary revenues, just think about any hotel. So food and beverage. Any food and beverage is considered ancillary revenue. Golf course, health club, spa, garage and parking, transportation, all of these. These could all be amenities that your hotel offers other than your rooms. The idea is that if you have all other amenities within your hotel, your room revenue is important. However, your non-room revenue, your ancillary revenues can actually bring in just as much. So you have to be aware of that during discounting times as well, that even though you may be discounting your rooms, you may be bringing in more money into your ancillary revenues, the other portions of your hotel. So there's an example in Excel where Fadwa, the revenue manager for the Harley House Hotel, has just received a call from Lawrence, the revenue manager, from a competitor. Lawrence's hotel is overbooked by 70 rooms for next Saturday due to an oversight. Therefore, he's looking to purchase that many rooms from Fadwa at their agreed to walk rate of $75 per night. So Lawrence he's got a full hotel, and he's overbooked by 70 rooms, and now he's contacted Fadwa and saying, okay, I would like to send you those 70 rooms at $75 per night. Okay. Fadwa's normal ADR is $129, and the cost of cleaning a room is $17. That would be a variable cost, right? Currently, Fadwa has 55 occupied rooms, arrivals and stayovers on the books for that day, and is forecasting that she can sell another 30 rooms for her normal ADR. The Harley House typically experiences an average of $8 in ancillary revenues per occupied room. So before accepting Lawrence's walks, Fadwa is going to analyze whether it makes sense or not, and we're going to help Fadwa make this decision. So let's go through each example. So with Lawrence walks, how many rooms would be sold? So if we take a look, current rooms sold to be forecast, okay, is 55. Okay. So additional rooms to be sold, what we believe, okay, so these are the ones that are currently sold. Fadwa believes she can sell 30 more rooms, but if she takes the walk rooms, all 70 of them, that's going to give us a full hotel, but we'll have to forego these 30 rooms at a higher level, at a higher ADR. So if we take a look, if we take the current rooms and we add in the walk rooms that are requested from Lawrence, if we add them together, we're probably going to have a full hotel, 125 rooms. Okay. So what's our average daily rate? Okay, so if we take a look, we need to add up the two revenues, the two different types of revenues that we're going to have, and divide it by how many rooms we're going to sell. So in this case, it's going to be how many rooms I've already got sold, the 55, times my normal average daily rate. So $129. Okay. And we need to add that to the 70 rooms that we've sold, that we're thinking about taking as walks, times the ADR that they're going to bring in. Okay. And when I combine these two, and I'm going to open up my brackets one last time. Okay. So all I've done here is I'm calculating, I'm trying to find out how much total revenue I should bring in. So the 55 rooms at $129 AD at average daily rate, and then the 70 rooms at the $75. And then I'm just going to divide that by how many rooms would be sold, 125. That would give me my average daily rate. Okay, so that will give me my $98.76. Okay. Now without Lawrence's walks, I believe that I'm going to have my 55 that I currently have sold, plus another 30. So I'll only have 85 of my rooms sold. Okay. So with the walks, I would have 125 rooms times $98.76 as my average rate. Okay. I would have $12,345 in rooms revenue. Without accepting these walks, I would have 85 rooms at $129 average daily rate. So all of a sudden, even though Okay? Even though I actually have a higher average daily rate, the fact that I have a higher occupancy has helped me, okay, get higher rooms revenues. But now let's see the effect that ancillary revenues have. So total rooms plus ancillary revenues. So daily room ancillary revenue. Okay, so FADWA has it that it's about $8 per occupied room. So in order to find out my total rooms plus ancillary revenue, I'm going to have to find out what my ancillary revenues are as well. So let's do our total rooms revenue, which we just discovered, and we're going to add in the $8 that we get per room times how many rooms we'd have occupied, so 125 rooms. So we would have $13,345 in total revenue. Now if we do the same here, and we add our $10,965, which is our rooms revenue estimate, and we're going to add in the $8 that we get for each room times the number of rooms that we would have sold, okay, that if we don't take these walks. So $11,645 would be our total revenue for that moment. So now we need to figure out our revenue per occupied room, our RevPOR. To do this, we're going to divide my total rooms plus my ancillary revenue, and we're going to divide it by how many occupied rooms we have. So $106.76. We'll do the same over here, my revenue plus my ancillary revenues. We're going to divide it by, which is my 11,645. We're going to divide it by how many rooms FADWA would have sold. So it'd be $137 revenue per occupied room. Okay? So again, some of these numbers are starting to point to the fact that, well, I have a higher average daily rate here. I have a higher revenue per occupied room, but total revenues, I'm still higher up by using my 125 rooms. My rooms department cost is still going to be $17 per room, per occupied room is still $17. Now my revenue per available room, I can divide my, I'm going to divide my rooms revenue. So my 12,345 divided by 125 rooms that are available. So $98.76. I'll do the same now with my rooms revenue for without the walks. And I actually have a lower RevPAR, and that's mostly due to the fact that I have lower occupancy. Now as far as my net total revenue, I'm going to have to now take away the cost per occupied room for my total rooms. So my $13,345 minus $17 at a cost per one room times the 125 rooms that I have booked. Okay, so my total rooms and ancillary revenues combined minus the cost for one occupied room times how many rooms I have occupied. So $11,220. If I do the same here, my $11,645 in total revenues, rooms and ancillaries, I'm going to take away how much it costs per occupied room, $17 times the 85 rooms, because we want to make sure that we take costs into account as well for all of our rooms. So $10,200. So at the end of the day, okay, we would have a higher revenue per available room, a higher net total revenue, okay, and more overall revenues by accepting these walks. Even though it's a higher average daily rate, okay, these ancillary revenues have provided us with quite a bit more money. If we take a look at the difference, okay, with the walks, 13,345 minus 12,345. All I'm doing is I'm going my total with ancillary minus my just my rooms. I have $1,000 in ancillary revenues. In my without my walks, I have 11,645 minus just my room revenue. I had 680. So if you take a look at the difference here, I'm going to make about $1,000 more in net total revenue, okay, with these walks right here, accepting these walks. 680 of that amount, okay, or sorry, 320 of that is going to be just for my ancillaries. Okay, so about a third of that amount is going to be for my ancillaries. So it can really it can have a big effect on whether or not you accept business. This is a great way to analyze whether or not you should accept walks, is to not only look at their rates and look at what it means for your occupancy and your RevPAR, but take a look at what it's going to be with your ancillary revenues. This is why some hotels will accept really big groups at a cheaper price, because they can probably make some more ancillary revenue from them. So that's just to point out the importance of non-room revenue or ancillary revenues. Now, how can we go about selecting room rates now that we've had that checked? There's a few different approaches. There's the dollar per thousand, the bottom-up approach, which we should know by now, and the other approaches. So the dollar per thousand is not used too often, but it's for every $1,000 of construction cost per room, they would add $1 to the room rate. Okay, so if you have $5 million construction costs, a 100-room hotel would charge $5 million divided by 100. Okay, so $50,000 per room. 50,000 divided by the 1,000, so the dollar per 1,000 would give you a $50 rate per room, and that's what you should charge. It's a very antiquated approach, and it doesn't really take into account demand. It doesn't take into account enough factors. It only takes into account the construction costs and kind of a return that you want on that construction. We do have a bottom-up approach though, which we want to use. So this is an example. We're going to go through another example actually within the Excel sheet instead of this one to make it a bit more visual. This would be for in class. So once we do discover this, once we've gone to their Excel sheet, okay, we need to find out our average daily rate. So just like our average check, we're going to try and figure out our required ADR to get our required revenues. So we go our total revenues or required revenues divided by the number of rooms in a hotel times the occupancy times the operating days. It really calculates the number of times someone rents a room, okay, or someone decides to pay for a room. It's the same thing as when we were talking about covers. Okay. So desired revenues, let's say they're $403,496. Okay. The hotel has 20 rooms. It's open 365 days a year, and we run at 55% annual occupancy. What is the goal average daily rate? So you would want to make sure that you are dividing your revenues by how many rooms you have available for one day times how many days are available times the annual occupancy. That would give you your occupied room nights for the year. Okay. So let's go through a couple of examples in Excel. So this is going to be it's the same approach for this part as we would that we would have gone through for the restaurants. So step one, what's our goal? Our desired net income after tax, it's right there, so our 90,000. Step two is calculate pre-tax income. So if you remember, it would be our income after tax, okay, divided by 1 minus our tax rate, so our 0.33. And that would give us our income before tax. Now, we can check the calculation by simply going 134,328 minus 134,328 times that tax rate. Okay, that should give us the same number as step one, 90,000, perfect. And then if we go to step 4, that would be determine our variable cost percentage, 42%. And step 5 is really let's do the math. So net income after tax, we have that as our 90,000. Operating income, which is our income before tax, we have that as our 134,328. Our taxes should be our 134,328, which is our operating income, our income before taxes, times our tax rate of 0.33, which is 33%. Again, as always, let's make sure we've done our math properly. 134,328 minus my taxes, and we'll leave out the cents because we're just talking about thousands of dollars. Yeah, sure enough, there's 90,000. We've done the math properly. Do we know our fixed expenses? Yes, we do. $200,000. Oh. Perfect. Now, to find out my required revenue, I need to do the same thing I did before. So we're going to add up our income before tax plus our fixed expenses, close our brackets, and we're going to divide it by 1 minus my variable cost percentage, which is 0.42. And that's going to give me my required revenue of $576,428 to make $90,000 in net income after tax. And now that I've got my required revenue, which is my 100% number, I can multiply it by my variable cost percentage to find out that I have $242,100 in variable expenses. So again, if we check and we go revenues minus variable expenses minus fixed expenses, I should have the same operating income. Perfect. So I've done all the calculations properly. Again, the way to explain this is, in order to reach my goal of $90,000 net income after tax, I will need to make $576,428 in revenues. So what does that mean with average daily rate? So we said $576,428, I believe. Yeah. So if I have 35 rooms, let's say, it's a small little hotel, and I believe I'm going to have 62.5% occupancy. That's my forecast. And 365 days a year. Or we can change this to forecasted room nights sold. So how can I know my forecasted room nights sold? Well, I know how many rooms I have. I know my occupancy. I know how many days in the year. I should be able to find this out just by going how many rooms I have available in one day times how many days I'm open in the year, which is 365, times my occupancy percentage, which is 0.625, 62.5%. That'll give me my room nights sold that I believe I'm going to have this year. So in this case, 7,984 rooms is what I believe I'm going to be selling. Okay. So if I know that I'm going to sell, that I believe I'm going to sell this many rooms, and these are the required revenues that I need to make my bottom line, I'm just simply going to divide my revenues, so my 576,428 divided by the number of rooms that I believe I'm going to sell. And that's going to give me an average rate of $72.20. What that means is, in order to get to my goal, okay, of $90,000, I need to make this much revenue. And if I want to make this much revenue, based on the fact that I believe I'm going to have 62.5% occupancy, I need to have an average daily rate of $72.20. And that's how you would communicate that. Okay? So we would want to make sure that using our revenue management, we can get to $72.20. Now, we want to make sure that we're able to also break it down by room type, because different rooms are going to charge different prices. So this would just be an overall average daily rate, just like we would have done for the restaurant to break it down by meal period. We're going to break it down by room type here. Okay, so total revenues is really our required revenue, $576,428. Okay. Number of rooms, 35. This hasn't changed, so what's my required room nights sold? My forecasted 7,984 rooms. Okay, so this is just something we would have just calculated in the previous example. Now, 65% of our rooms are typically queen rooms. That's the break as far as how many people reserve which type of rooms. The room mix breakdown. Of the rooms that we sell, 65% are typically queens, 35% are typically king. So or 7,984 rooms times 0.65 should tell us, of these rooms that I believe I'm going to sell, how many of them should be queen. 5,190. And we can do the same here, where we would go our 7,984 rooms times how many we believe are going to be king rooms that are sold. Okay? 2,794. Now, we now need to use some algebra to figure out the required average daily rate of just a queen room. After that, because king rooms sell for $20 more, we'll be able to add $20 to that average daily rate to discover our king average daily rate. So how do we do this? We need to start off with our total required revenue. And that's what we're going to use. So we're $576,428. To get to that number, we need to multiply how many rooms we're going to sell of the queens times X. What X is going to be is this required average daily rate. We're trying to solve for what the rate should be for the queen, what we need to charge in order to get this number. Okay. Now we've only accounted for a portion of all the room nights sold, so we need to also add in the number of rooms, king rooms, that we need to sell, multiplied by our price plus the $20 more that we charge. Okay. So X is again our price, our X plus 20. Okay, our X is what we're trying to solve for, which is our average daily rate for queens. The reason why we're multiplying this many rooms, which is our king rooms, by X plus 20 is the fact that we charge $20 more than queen rooms. So again, X is what we're trying to find out, okay, and the X is the required average daily rate for queen rooms. So now we need to go step by step and start to solve for this. So we'll keep $576,428, and that's going to equal, we can stick with $5,190 times X. That won't change for now. But now what we can do here, if you remember from your math courses, we can multiply our 2,794 by X, and then also 2,794 by 20. Okay? So if we do that, we should get $2,794 times X now. And the reason why I'm using the star that we use in Excel is just so that you don't get confused from the X and the star here. Okay? And we can also add in whatever 2,794 times 20 equals. So that would be 55,880. Okay? So all we're doing here is we're starting to try and solve for X. Okay? So I multiplied this number by X to find out this part, and then I multiplied my number of rooms for kings times $20 more that they're going to have to find out my 55,880. What we can now do is we can start to bring over this number over to this side. If it's being added over here, in order to cancel out over here, we need to subtract it on both sides, which is what we're going to do. So $576,428 minus the 55,880. Okay? So that's going to be, all we're doing is we're bringing over this part of this equation over to this side. So we have to subtract it in order to bring it over here. Now, for these two, if you take a look, this is very similar to this in that they're both numbers are being multiplied by X. So we can just simply add these two numbers together and multiply them by X. So that would be 7,984 multiplied by X. This should look familiar because it's really the total number of room nights that you require to sell. Okay. So let's go to our next step. Okay. This should equal $520,548 equals 7,984 times X. So if I'm multiplying 7,984 times X, in order to cancel it out over here, I need to divide by 7,984, but I also need to do the same over here. So I would go $520,548 divided by 7,984, and that would cancel it out on the other side, leaving me with just X. Okay. And if I do the math, I should have $65.20, which equals X. And if you remember from the beginning, X is the required average daily rate that I have for Queen. So I'll make that into dollars. There you go. Okay. Now, Kings sell for $20 more, so they would just sell for $65.20 plus $20. And sorry, we'll make that into dollars. So now that I know that my required average daily rate for Queens is $65.20 because they sell 65% of the time, I can find out my revenue per room type. So my $65.20 that I sell Queens at plus the forecasted room nights sold, 5,190 rooms that I think I'm going to sell of Queen, should give me how much revenue I'm going to bring in just for Queen rooms. If I do the same, 2,794 times my $85.20 that I'm going to get per King rooms because they sell for $20 more, I'll now get the revenues that are going to come out of Kings. If I've done this properly, okay, I should have a number very close by adding these two together, okay, adding both types of revenues together. I should have a number, if I put this in dollars, and sorry, I'll make it bigger, that's extremely close to this number. Okay? And again, we're talking about a simple amount of rounding, which would be the difference. It's a difference of $9. So we're very close to that. Okay? So again, what does it all mean? Let's talk it out. Okay? In order to get my required, so let's start from the beginning. In order to get my $90,000 net income after tax goal, I need to have $576,000 revenue. Okay, $576,428 in revenue. That means that I have to have an overall average daily rate of $72.20 based on the fact that I would have an occupancy of 62.5%. Because King rooms sell for $20 more, okay, I'm going to have to sell and the fact that whenever I sell rooms, 65% of them are Queen rooms, 35% are King rooms. This is my room night breakdown, and this is how much my average daily rate needs to be for Queen, and this is how much it needs to be for King, based on all of these forecasts. And if I do all that, then I should be able to get to my required revenue, which again brings you all the way back, should hopefully bring me to my net income after tax. Okay. It's quite loaded, so please take your time, go back and review that example again, please, because you really need to feel comfortable with it. So, what's a few other approaches that can be taken here? Some hotels will base their rates off of square footage. Okay? Some will do it just based on what managers really want. It's something that's ideal that they really want to. Okay? A lot of the time, though, what's happening now is the fact that the internet has really become a big player in a big factor in how we're setting our rates in hotels. What used to happen a lot more is that revenue managers would call around and find out the prices from different hotels, what they're offering for a day, and then they would take that into account for their competition. Now, revenue managers can just look online and they can filter very quickly what people are doing and find out what their competitive set is charging and then base their rates off of that. They could also follow the leader, and what that means is really try and charge whatever the top hotel is charging in the area. The only thing you have to be careful about is that if you're following the leader, you want to make sure that you're offering the same type of value, the same type of offering that they are. Some will use prestige pricing. And that is where you're just basically charging the highest amount, the highest rate in the area. You're going to go even higher than the leader. And it's basically you want to justify that rate with what you're offering. Make sure that you're offering value. And then discount approach would be simply you're just providing a rate that's much lower than your competitors to try and attract more people. Really the fact that we're using the internet more and our competitors in hotels are using the hotel a lot, the internet a lot more, it really gives everyone a lot more of an ability to monitor what's going on. Not only you as a hotelier, you as a manager of a hotel, but also customers. People have a lot more access to the internet and different rates from different hotels and competitive sets. So this is why revenue managers pay attention to them quite a bit. So that's your presentation on hotel pricing and bottom-up approach to hotel pricing.